Welcome to the ARMR Report, ladies and gentlemen. I'm Brett Rosenthal, apparently today. Good morning, everybody. Hope you had a great holiday, had some time off, had some time to think. Let's get right to our morning meeting. What we're going to be talking about, as always, is our trading posture, how we intend to day trade today, and then the investing posture. Okay, so as always, this is a reflection of how I run my own personal capital. I follow the ARMR principles, which are basically 3 simple steps to running money. Build the whiteboard, fundamental ideas, do our research, find ideas we want to own, start monitoring those ideas. Then use our algorithms to determine when to add risk, take risk off. And of course, wrap it all up in a bow of stop losses to protect ourselves. So really step one, what drives the whole decision is the risk monitor and whether or not we're red, green, or yellow. And we've been red since early December, and the market's been very volatile, really gone nowhere. But in the last 3 or 4 days leading up to Christmas, we had that light volume rally right towards the high. So it looks like the market's about to break out. So let's address that first today. The risk monitor will not go green. There is not any confluence in the market. We have too many leading stocks that have been absolutely destroyed. Investment themes such as crypto and uranium and things that were high-flying ideas that have been destroyed and ripped right back down to their moving averages, whatnot. And that takes time to build a new base to jump off of. Now, what I share with you are statistically significant thoughts. That's what I try to share. I try to stay away from just my opinion or what I think the market might do or any of the other things that people do on CNBC that totally waste time. What I'm trying to tell you is, statistically speaking, when an asset gets destroyed, it takes time to build a base before it launches the next move of its bull run, if there is a bull run. Okay, so things don't just collapse, reverse, and skyrocket. Can it happen? Sure, every now and then it happens. There's V bottoms that happen. I would submit to you they happen primarily in big indexes that are controlled by options / Fed intervention. So there you can get V bottoms. But generally speaking, when an asset gets destroyed, the average investor thinks, oh, great, it's been destroyed. Let's run out and buy it. And then gets incredibly frustrated because either A, the falling knife cuts off fingers and continues to go lower, or B, it takes weeks to build a solid base before the next move starts. So I avoid those names. And that's the bifurcation in the market, the non-confirmation, right? We have 6 or 7 big cap technology stocks that are dragging the whole market higher, and they have been all year. If you own those names, or if you're an index investor, you had a great year. If you tried to think outside the box, think innovation, think about things that generally create wealth over a long period of time, and invest in those names, chances are you're losing money this year. And if you're not using stop losses, you've been destroyed. So what we have to try to figure out is, where are we in the cycle of the market? The risk monitor is not going to go green because of this non-confluence. But I will submit to you that we are seasonally in a great period of time. It's always true. I mean, let's talk statistics again before I put my own opinion in the way and start forcing my will on the market and say to you, well, the risk monitor can't go green, so I can't put money to work. Before I do that, which will be forcing my will on the market, saying the market can't go up because we have these problems, I will, on the other hand, say to you, hey, it's a Santa rally. Market goes up at the end of the year. You know, it's been a great year for indexes, so they're probably going to be marked up this week. That could spill over into January. I've seen that happen a lot. So there could be a swing trading rally that lasts for a month. Absolutely. That can happen at any time. And so I've said this for a while. Those of you who are new to the ARMR Report or might not have heard this, guys who've been here with me for a while know this. The risk monitor is a probability algorithm. There will be times where we're out of the market and the market goes up for a month. It can happen. I've seen it happen. I've been part of it. It's frustrating. The way to mitigate the frustration is to put some capital to work if you want, but recognize the type of market you're in. It's a swing trading market. We're not looking for huge gains going forward that you buy a stock and you hold it for a year because the whole thing skyrockets. We're not in that environment, right? We have a risk monitor that's not, if anything, I'll turn it yellow by the end of the day so that I can express through the color what type of market we're in. But in reality, what we're dealing with is a short-term phenomenon of strength into the end of the years, possibly spills over into January, with the backdrop of a Fed reducing liquidity and raising interest rates, which, historically speaking, this is one of those statistical situations where like 100% of the time the market goes down when the Fed's doing that. I mean, go find a time for me when the Fed's reducing liquidity and raising rates where the market skyrockets. At best, you might find periods of wild volatility. So there'll be rips higher, which are swing trades, and collapses lower, which are swing trades, with no major direction. And then you look back over 6 months and say, hey, the market hasn't gone anywhere, but there's been like a washing machine. You might find those periods of time. So you could argue with me, if you wish, that the Fed might not do what it says. That's true. The Fed could be jawboning, saying they're going to do something. But when we look at the data 3-4 months from now, we'll realize nobody's balance sheet really got reduced. I can't start chasing those, rabbit holes. I can't fall down those rabbit holes or start doing conspiracy theories, right? So all I could do is look at the facts. When the Fed's doing this, it's typically bad for the market. But at the same time, we're at the end of the year. It's been a good year for indexes. We can expect a markup. It could spill over to January. January, February are usually good times a year because pension plans are funded and that money finds its way into the market. Okay, so that's what we're dealing with. So let's jump to our trading posture. First of all, I come into the morning and I'm trying I'm going to do it, right? There's do or do not. There's no try, right? No bias, no ego. I'm going to trade what I see. So we're opening. I would call this a flat open. It looks like the indexes are higher, but if you look at the trading on Thursday, the market sold off in the last 6 minutes. They had this like 6-minute swoon back down to the VWAP. In fact, the Dow went through the VWAP. So what they're doing right now is they're just recovering the last 6 minutes, which was just regular shenanigans in the last 15 minutes. Usually the markets will rip higher at the end of the day. They'll sell off. And if they sell off at the end of the day, they open higher. So to me, this is like a flat open if you look where the market's trading. So we go to our playbook and we start to say, okay, flat opens, what do we look for? The market opens, it goes sideways for half an hour or an hour, somewhere between the VWAP and the opening range high, pops above the VWAP, we get long for the continuation rally. That's play right out of the playbook, okay? We did it last week. So we'll look for that again. Do investors come back from their vacation and put capital to work and we get that continuation trade? We'll always, ideally to me, the market will open and immediately sell off, test levels from last week's light volume rally. And if those levels hold and reverse, then we'll look to get long those trades on reversals. That'll be like a crazy Ivan to me. I hope that happens. That'd be great. Market opens higher, immediately sells off. I won't short that immediate sell-off. And if it sets up a bottom, boom, we'll put that trade on. The short side would be more like this. It opens higher. It climbs above the opening range high right out of the gate, okay? And then it just can't go anywhere after like an hour and breaks back below VWAP. Boom, that'll be a place where I put a short on. So that's my trading posture. I'm going to just see which play shows up, and we'll play that. We'll look at the ARMR Playbook, and we'll put that play on. So that's my trading posture. And it's hard, so it's really hard for me to come out here and tell you. I don't want to tell you what I think the market's going to do because that doesn't matter. All I want us to say in the morning mantra is we're going to trade what we see. No ego, no bias, trade what we see. We get a setup, we trade it. It's tough to do because I want to say to you, my bias is I think the market's going up, okay? Because it's the end of the month, end of the year, been a good year for indexes, probably going to mark those indexes up. So I'm looking for those long opportunities. But if we get that open higher, drift sideways, break below VWAP, I'm putting that short out. I don't care what my bias is, okay? Because that'll be a money trade if it works. There'll be a lot of money to be made there. So, all right. If I go risk monitor yellow by the end of the day, what would get me to do that? Let's say there's volume that comes in today. We see that the William O'Neill once again has turned green. So they've been yellow and green and yellow and green. So now they're back to green. They think the market's going up. So they don't care about the light volume into Christmas. They're saying it's a real time to put money to work. I'm watching spot gamma. I really want to see if that call wall rolls higher. If it does, boy, that's going to make my bias even more long. Okay. It doesn't mean I won't trade on the short side, but I'm really looking to get a long trade on. Ideally, if I'm yellow by the end of the day, which is, I'm going to say to you guys, look, there's no confluence. It's a dangerous market, but I concede that a double bottom is in at the 50-day moving average on the big indexes, and they're breaking out. So time to put some money to work for however long that lasts. Okay. And what I'll do, first thing I want to do is go to my whiteboard, find my favorite names, start filling out that part of the portfolio. Probably going to have about 30% of my capital in individual names. I usually put about 25% of my capital into indexes using the doubles, right? So that gives me 50% exposure to the market during a risk monitor green signal. This is not green. So I might try to swing trade a 25% exposure to the market just to get a piece. I might put that trade on and use a larger amount of my capital to day trade. I'd really rather day trade the rallies on the indexes right now. So I might put on a piece, but it'll be a smaller piece. So my focus into the end of the year is probably buying my favorite names off of the whiteboard, putting them in the portfolio, maybe an ETF here or there of a theme that I want to try to get long. Not sure what that is right now, but I'm looking. I'm not really looking to bottom fish right now. So let's go over the top names. Okay, these are the names that I really want to own. Trade Desk is the number one name on my desk. This is the number one stock I want to own. This will be the first stock I put in the portfolio. I'm going to look to pick up that stock today. Okay. I think MDB is a name I'd like to own. I could see owning Snow. I could see owning maybe AMD. That's a test of the 50 that's holding. The semi stocks look really good. I think that after listening to the AMAC call and looking at that chart pattern, I can easily own Applied Materials, and the same exact chart pattern is set up on Microchip. Those are two of my favorite patterns right there. Okay. So those are just some of the names. I think Datadog looks interesting to me. These are blowout earnings, blowout growth opportunities, pullbacks to key moving averages, clear double bottoms, stuff like that. I could see putting those in the portfolio. Okay. So that means on the live trading desk, I'm going to be looking to trade those names this morning, see if I could find my way into them. And if I get an opportunity on the indexes, I'm going to be looking to these names and saying, oh, there's the index entry point. What do those names look like? Boom, let's put those names on. If they rally into the end of the day, I hold them for a swing trade in the portfolio, and I call it risk monitor yellow, right? If they roll over, break down, the whole market breaks down, those trades don't work. They don't get held overnight. There is no risk monitor yellow. That's kind of where we stand today on Monday. So for somebody new to the ARMR report, I update the ARMR portfolio update channel in the Slack room during the day if I'm adding something, but it is not an official ad until 3:45. So if you don't want to be trading during the day, you just want to figure out what's being added to the portfolio at the end of the day, then you must wait until 345. Sometimes you'll end up, the price will be higher than where I bought it, right? Sometimes it'll be lower than where I bought it. We don't know, right? So I'm just saying, if you're in there trading all day with us, you can watch what I'm doing. But if you wanted to see, hey, I got to go to work and I can't trade it all day, then all you really have to do is see where we are at 345. I'm going to update the official update. This is what's been added to the spreadsheet. And then you'll know what we're doing, and I'll shift to risk monitor yellow at that time if it's happened. It'll be 345 when I put that in. Okay. And of course, there's no rush to the close. I mean, just because I put it on at 345 doesn't mean you won't get a better price the following morning. That's probably 50-50. Okay. So there's no urgency there. Sometimes there is. So I'm just saying, over a large body of evidence, there'll be some times where we see that entry point at 345 and the stocks gap up the next morning. Sometimes it happens. Other times, they sell off. So the ARMR report is a guide. This is how I run my own money. You got to make your own decisions, do your own research, figure out your own risk tolerance, decide how you want to run your own capital. I'm just sharing with you how I do it. And I do it through those sections of the website and the Slack room, the portfolio, the risk monitor, the whiteboard, those types of things. So that's my process today. We'll see what happens. Any questions you guys have? If not, I'm going to go set up the live trading desk. I do want to I want to highlight this trade. I'm going to try to highlight these types of trades a little bit more on the trading desk, on the live trading desk. So what I really want to try to do is find this setup. This setup, notoriously, this is one of the greatest setups for day trading individual stocks, or ETFs or what have you. What you see here is the ARMR moving average, this yellow line. Okay. What we're looking for are assets that broke above that line the prior day and consolidated at that line. The next morning, we look for a test of that ARMR moving average. If it holds, which it did right here, this is BLOK on Thursday. If it holds and pops above the VWAP, that's where you put the trade on, and you can capture trades like this, just huge trades. It's the ARMR moving average. It's going from below that average to above it. That's the trigger. Then you wait for the test. If you get it, you want to get on that trade. So this doesn't happen every day. But what we want to try to do is capture this every time we see it, because there's a high probability you make money, and the money you make is enormous versus the risk you're taking, which would have just been really the low of this day would have been the stop. So the risk would have been tiny. What was the risk? I'm putting a trade on there. It's tiny versus the reward you're going to get paid. So I'm going to be searching for these trades more often on the live trading desk. I tend to focus primarily on trading the indexes, but I do think it's worthwhile for us to keep our eye, whatever our favorite names are. And ARMR Insiders, if you got an idea, hey, what do you think of this? Let's look at it in relation to that moving average and how it's setting up on the ARMR PMP. And if we get that correct setup, boom, that's the entry point to put some trades on in names that are not just the indexes, where I like to focus. Okay. Any questions? Anybody out there? Am I talking to myself? No, I can see I'm not, but I would suspect there'll be a lot of people off the desk this week as well, because it's the end of the year. So we'll just have some fun today. All right. I'll see you guys on the flip side. ARMR Insiders that are part of the live trading desk, I'll see you under that channel, live trading desk, ARMR Pro live trading desk channel, hopefully around 9:15, which is kind of a joke. Wink, wink. I never make it by 9:15, but I'll try. And if we're going to risk monitor yellow and I'm adding names to the portfolio today, then I will be doing an in-game update. And I'll probably do it at 3:00, and I'll take you to the close, or maybe 2:30, and take you to 3:30, for that hour, right? And then at 3:30 I'll sign off, and I'll execute whatever I have to execute to build my portfolio. So let's say 2:30. If there's a risk monitor yellow and risk monitor change that's occurring, I'll see you again live on this channel for an in-game update, and I'll share with you the stocks that I'm positioning and some thoughts, and take any questions you have. All right. Have a great trading day. Stay nimble, my friends.